Let's begin our exploration into the fascinating world of financial markets and institutions today. These essential structures truly form the backbone of our economy, facilitating transactions and growth. We will now explore the two major types of financial markets that are crucial for economic activity. These markets cater to different needs, distinguishing between long-term investments and short-term financial requirements. First, we have capital markets, designed for raising long-term funds for businesses and governments. This is where long-term debt, or equity-backed securities, are actively bought and sold among investors. It notably includes both stock and bond markets, essential for companies to raise long-term capital. Secondly, let's look at money markets, which specialize in trading short-term debt instruments. Here, short-term debt instruments are traded, providing immediate liquidity for various financial needs. They primarily focus on highly liquid, short-maturity instruments, crucial for managing daily cash flows. Now, let's dive into the core functions of stock markets, which are vital for economic development. These functions are key to driving economic growth and encouraging broad investor participation in the market. A primary function is capital formation, where companies raise funds to expand their operations and innovate. Through stock markets, companies can effectively raise the necessary funds for their expansion projects. Another crucial function is liquidity, allowing investors to easily buy and sell their shares. This ensures that investors can readily purchase or sell shares without significant delays or price impact. We also have price discovery, where stock prices reflect a company's perceived value in real time. Stock prices continuously adjust, reflecting the true market value of the company and its prospects. Finally, there's risk distribution, spreading investment risk among a large number of participants. This mechanism helps in spreading investment risk broadly across many different investors. Let's trace the journey of a stock, from its initial public offering to its daily trading life. This journey begins with a company's launch and continues through its active daily trading on exchanges. The journey often starts with an initial public offering, or IPO, a significant milestone. Here, a company offers its shares to the public for the very first time to raise essential capital. Following the IPO, we enter secondary market trading, where shares change hands among investors. After the initial public offering, shares are actively bought and sold among individual investors. Finally, stock indices like Sensex and Nifty help us track overall market performance daily. Indices such as Sensex and Nifty provide a comprehensive benchmark to track the overall market performance. Now, let's shift our focus to understanding bond markets, another vital component of financial systems. Bond markets are crucial spaces where investors actively buy and sell debt securities, primarily known as bonds. These fixed-income instruments represent loans from investors to governments or corporations, vital for raising capital, providing stable income, and diversifying investment portfolios. Let's explore the key financial intermediaries that play a crucial role in our financial system. These institutions effectively bridge the gap, connecting savers with those who need to borrow funds. Commercial banks are fundamental intermediaries. They accept deposits and provide a wide range of loans. They primarily accept customer deposits and then provide various types of loans to individuals and businesses. Investment banks specialize in helping companies raise capital by issuing and selling securities. These banks assist companies in raising capital through the issuance and sale of various securities. Mutual funds are popular intermediaries that pool money from many investors for diversified investments. They gather money from multiple investors to create a diversified portfolio of investments. Insurance companies provide essential protection, safeguarding individuals and businesses against financial losses. These companies offer protection to clients, guarding them against potential financial losses and risks. Finally, pension funds manage retirement savings, ensuring future income for their beneficiaries. Pension funds meticulously manage retirement savings, aiming to provide a steady income in the future. Let's explore why financial intermediaries are so important for our economic system and individual investors. They are absolutely crucial for maintaining a healthy and efficient financial ecosystem within any economy. First, let's consider the significant economic impact that these intermediaries have on our society. They ensure the efficient allocation of resources, channeling funds to the most productive uses within the economy. Intermediaries also facilitate transactions, streamlining both the borrowing and lending processes for everyone involved. Now, let's look at the direct benefits that investors gain from the presence of these intermediaries. They help in risk reduction by diversifying investments and offering various forms of insurance to protect assets. Intermediaries also enhance liquidity, making it much easier for you to convert investments into cash when needed. Finally, they provide a wide array of essential financial services and products that cater to diverse needs. Let's turn our attention to the key regulators who oversee the financial landscape in India. Their primary role is ensuring stability and providing crucial protection for investors across the markets. First up, we have SEBI, which stands for the Securities and Exchange Board of India. SEBI is responsible for overseeing both the stock and bond markets in India, ensuring fair play. It ensures transparency and actively works to protect the interests of all investors in the market. Next, we have the Reserve Bank of India, commonly known as the RBI. The RBI plays a vital role in regulating banks and the money markets within the country. It also manages India's monetary policy and oversees the issuance of government bonds. Then there's IRDAI, the Insurance Regulatory and Development Authority of India. IRDAI is specifically tasked with regulating all insurance companies operating in India. Its main objective is to protect the interests of policyholders, ensuring fairness and security. Finally, we have the PFRDA, which is the Pension Fund Regulatory and Development Authority. The PFRDA is responsible for regulating the entire pension sector in India. It also specifically manages the national pension system, often referred to as NPS. Let's delve into the crucial and multifaceted roles that a central bank performs in an economy. Central banks truly act as the guardians of economic stability, guiding the nation's financial health. One of their primary roles is implementing monetary policy to influence economic activity. This involves controlling the money supply and setting key interest rates to manage inflation and growth. Another critical role is maintaining overall financial stability within the banking system. They continuously monitor risks across the financial system to prevent crises and ensure smooth operation. Central banks are also solely responsible for the issuance of national currency. They issue and regulate the national currency, ensuring its integrity and public trust. Furthermore, the central bank acts as the banker for the government itself. They provide essential banking services to the government, managing its accounts and financial transactions. Lastly, they play a crucial role in the regulation and supervision of commercial banks. This oversight ensures that commercial banks operate soundly and adhere to financial regulations. Let's discuss how central banks use various tools to effectively manage and guide the economy. They use tools like policy rates, such as the repo rate, to influence bank borrowing costs and control money supply. Let's quickly review the main points and key takeaways from our discussion on financial markets and institutions. These are the essential takeaways you should remember to deepen your understanding of the financial world. Remember, financial markets are crucial for raising capital and effectively transferring risk among participants. Stock markets facilitate equity trading, while bond markets are where debt instruments are actively traded. Financial intermediaries play a vital role in connecting savers with borrowers and managing associated risks. Regulators such as SEBI, RBI, IRDAI, and PFRDA are essential for ensuring market integrity and trust. Central banks implement monetary policy to control inflation and foster sustainable economic growth. Comprehending these fundamental elements is absolutely vital for understanding how the entire economy functions.